I think the beauty of the PEP is that you can fill it up with ammunition that you don't necessarily have to use. And I think, the idea of the PEP being a very potent sort of bazooka that can cow bond markets and keep yields across the whole of the euro area very low so that governments can continue to borrow as much as they need to deal with both the pandemic and maybe some of the consequences of a no-deal Brexit. Actually, building up the ammunition within the PEP so that bond markets don't fear any dislocations next year would be phenomenally useful. So I think, funnily enough, I think the more the ECB announces today in terms of the increase of the PEP, the more effective it will be at both helping Europe through what's proving to be a pretty tough winter in terms of lockdowns, but also in terms of the consequences of no-deal Brexit. And in fact, the more they announce, the less they may actually have to end up buying.
Interesting. So they go for the shock and awe approach rather than sort of drip feed it out over the course of 2021. We've spoken about the PEP. How effective has TLTRO been in providing policy support to the overall recovery in your view?
I think it's been very useful. I think it is, once again, something the ECB seems to be looking closely at, extending and improving the conditions at. I think, what the TLTRO was really good at in the spring of this year was, along with the government loan guarantees that we had at the time, allowing banks to massively increase their balance sheets, lend huge volumes to the corporate sector, and ensure that businesses, if they needed liquidity in order to be able to survive, to make payments to suppliers or employees or creditors, they were able to do so. So I think the TLTROs have been phenomenally effective. I think cutting the interest rate below the deposit rate earlier this year was a revolutionary and really important step that provides a strong incentive, a strong profit incentive for banks to lend on to businesses. So I think they're a really crucial part of the toolkit. Whether they're urgently needed now, I'm a bit more skeptical of, because we've seen businesses hoard the cash that they've borrowed from banks earlier this year. So I don't think there's a liquidity problem in the corporate sector at the moment in the way that there very much was in the spring of this year. But I think the usefulness of the TLTROs and making the TLTROs more generous is that, if because of the lockdowns we're seeing, or if because of a no-deal Brexit, suddenly businesses find themselves in need of pulling on a credit line from the banks, the TLTROs would mean that the banks were in a position to be able to extend that money in a way that they'd be more concerned or less willing to do so if the ECB doesn't improve the terms today.
Neville, I just want to come back to the comment you made around the ECB's announcement today, saying that the more aggressive the ECB's announcement, the less of its balance sheet it may actually end up having to use. That has clearly been the case before. Is there a limit to how long this phenomenon can last in terms of how long the market believes the ECB can actually affect the economic recovery and affect change when it comes to bond markets?
I think the market is going to be aware that if the ECB has huge firepower to keep yields low or prevent fragmentation, and some countries' yields spike up, then the market is not going to be willing to take on $1 trillion or half $1 trillion euros of firepower from the European Central Bank, particularly if that's also backed up by the European Recovery Fund. And I think the idea that with a strong threat from the central bank, bond markets can find their place is obviously a precedent we had back in 2012 with the OMT from Mario Draghi, where he basically unveiled a bazooka that achieved the outcomes that bazooka was intended to achieve without using a single euro of the ECB's balance sheet in doing so. So I think the markets will feel confident. I think if the ECB has got a large PEP to be able to deploy, plus knowing that the recovery fund is going to be used at some point in 2021 to support countries like Italy and Spain, and that will allow yields to remain very low and very stable, which crucially means that really where the action is governments continuing to provide supports for their economy. And of course, with bond markets where they are, governments have no problem issuing debt to be able to finance things like furlough schemes and the economic stimulus that's going to be required to pull the euro area out of recession as vaccines roll out next year.